All right. Let's now connect with the management of Ujjivan Small Finance Bank to talk about how things have moved for the quarter gone by. Nitin Chugh joins us now. Nitin, Ujjivan Small Finance Bank has reported a loss in the quarter gone by. NPAs have gone up sharply. Is this largely because of the COVID second wave?
Yeah, so see, we reported a loss of around 233 crores, largely for the fact that we've taken accelerated provisions of 250 crores. Okay, and in terms of the GNPA, that also went up from 7% of the last quarter to about 9.8%. So yes, there is stress on account of the second wave, which was kind of unprecedented in the manner that it affected us. And we do think that the impact of the second wave will probably going to play out over this quarter as well. So on that account and on that basis, we've gone ahead and taken these provisions, and that's how we've reported a loss in this quarter.
You mentioned that there is a COVID impact in the second quarter. Could you tell us what kind of provisioning you've done and what kind of NPAs do you expect in FY22?
Yeah, see, we need to go through this in a manner that we are able to estimate, as things play out. So, like we know for a fact that things have really improved remarkably in July. Our collections efficiency has gone up to 93%, and the business is also recovering. I think it's a good thing to probably go through this whole quarter and then come to that conclusion as to how much more provisions, if at all, in that quarter or even subsequently in the rest of the financial year would be required. But at this point in time, things are still evolving and moving. Multiple parts are moving, so it's very difficult to provide any kind of an estimate on that.
Right. Mr. Chugh, wanted to understand, what led to the high NPAs for you? Is it because of the impact that you had on customer cash flows, more because of the inability to collect because of the mobility restrictions? Or is the scenario that there was a case for any provision write back or recoveries that you expect over FY22?
See, I think we've had an impact on both counts. One, for the fact that uh, there was a heightened level of infectivity in the entire country. Our staff got infected. There were customers who got infected. We had a lot of loss of life also on the customer side. We also lost 9 of our colleagues to the second wave. That apart, there has been a loss of livelihood for sure. The other thing that was also very clearly happening was that people were preserving the cash that they had because the livelihood had come to a halt or an abrupt disruption. So people were also holding on to a lot of money or whatever little money that they have. And also, please remember, we deal with nearly 68% of our portfolio is microfinance, and these are really the very small borrowers. The loan outstanding is usually in the range of 30 to 40,000 rupees, and these people get hit the hardest. So, when they start paying back, which is what we are seeing in July, that is when their business starts to recover, their livelihood starts to recover, and on that basis alone, we need to give them time. And this is a segment which cannot bounce back, in the next month that the lockdown gets lifted. They lose livelihood, they lose their cash flows and their income even for a month or two. It sets them back by that much in their cost flow or cash flows, etc. And therefore the recovery has to happen over a period of time, and usually that's how it's happened in the past also. So I think going forward, as things improve, and there are certain segments which get more impacted all the time, like people who are really dependent on mobility and people who really need to go to work, and of course our own people, because of the inability to move around for a very long period of time, and the infections that we saw in our own staff was also a restriction that we had in this whole quarter. And I think once things start to ease out as they are now, and we just hope that we don't have to confront a third wave anymore, we are hoping that people will be back on their feet rather sooner. So what we are certainly noticing this time is that the recovery would be a lot sharper and quicker, but it's just that certain segments can take a little longer.
Cautious on your loan book growth, given that over 60% of your exposure to MFI segment, which has been the worst impacted?
See, we had put out a guidance in our first last quarter earnings call of somewhere between 20 to 25% growth in our book. I think we will need to recalibrate as things improve, because the impact of the second wave was not completely known in the month of May when we had our results for the Q4 of last financial year. But there is certainly a momentum. You see, the demand has come back. There is demand for credit. Now, the only thing is that when customers don't pay for a prolonged period of time, they become ineligible, their credit bureau scores get impacted. So they have to be assisted in different manners. And that is why, if you notice in our press release also, we have mentioned that, we would be undertaking restructuring, the second version of the restructuring over this quarter, because that really needs an assessment on the ground. So things will definitely improve is what we are confident of. But at the same time, we do want to be careful and conservative and not open up things, rather rapidly. We would rather want to do that a little gradually as things improve and take those measured kind of calls in terms of giving access to credit. Because the demand is certainly there. It's just that we need to be careful about, to what extent customers will have the ability to repay.
All right. Mr. Chugh, let's talk about the regulatory environment. Recently, the RBI approved the whole merger with respect to the holding company with the Small Finance Bank. When do we see that happening? And if you could share some timelines, please.
So what RBI has done is that they have allowed us to apply 3 months before we complete 5 years, which the earlier norm was that you can apply only after completing 5 years. Okay, so that's the principal change in the overall approach. We finished 5 years on 31st January 2022, and 3 months prior to that, we would apply to RBI. There are certain procedural steps before that we have to go through, and we once we apply, and then it's a whole process of RBI approval and other regulatory approvals, which is what again we put out in the investor presentation also. We do expect this whole process to get completed in about 12 months time.
Okay. Now, you've stated your intent of becoming a universal small finance bank. Is that something that you are working towards? And also from an investor perspective who's looking at, Ujjivan SFB from a 3-4 year perspective, what's the growth strategy you'd like to share and the return ratios, profit targets that you expect?
So the universal bank aspiration is very much there. However, the first priority for us would be to complete the reverse merger. And once that is completed is when we would want to look at converting ourselves to a universal bank, which again is allowed only after completing 5 years. So I think we would be in the same window of the space that we are required to apply for converting to a universal bank. But I think more importantly, we need to prepare ourselves to become a universal bank rather than on one fine day you convert yourself. So that level of preparation, whether through diversification or by building a high quality liability franchise or the digital strategy or opening up treasury or doing other lines of businesses, those are the capabilities that we are building while we have the time. And by the time I think we would be ready for asking for this conversion, we would also be prepared as an organization to work like a universal bank, and it should not just be a change in the nomenclature. Now on the growth, I think we did put out 3 years sort of a roadmap about a year and a half back when we had raised capital and during our IPO. Broadly, the two things that I would like to talk about, which to our mind are not going to change other than this whole period of COVID that has impacted us. One is the ROA that we do expect to be in the range of 2.2 to 2.3%, and the ROE in the range of about 15 to 17 or 16 to 18% is the range that we're looking at. Of course, the growth will happen, and as soon as we get into normal circumstances after the the COVID scare is over and we don't have to confront ourselves with any more waves, then we would be back to our usual growth trajectory. And we have been growing at something like 25 to 30% in the past also, and in some years even more than that. So we don't see a problem with that. And on that basis, I think we do expect the ROA and the ROE to stabilize around that level.